Hello and welcome back to the Wealth Building Strategy series. Today we're going to be talking about understanding private money partnerships. Just a little bit about DMI Holdings. DMI Holdings is a privately held equity investment company which provides investors with a relationship-driven, trustworthy, and profitable partner who implements alternative strategies for growing wealth. We build lifelong relationships with our clients by being transparent and by using a disciplined, research-focused approach with the objective to produce consistent above-market returns for our investors. My name is Eric Mattingly. I'm the CEO and founder of DMI Holdings. So a little bit about my background. I was in the martial arts industry for many years and through a series of pretty serious injuries and at the time had gotten involved in real estate investing, met a friend of mine and wound up going into the private capital industry. So since that time, I've been involved in organizing over $1 billion in investment transactions, and we've done a lot of different types of real estate projects, business expansion opportunities, as well as opportunistic assets, which we'll show you in our DMI Holdings company overview at a later time. Private money basics. So we're just going to cover a few fundamentals with regard to private money. Investors have a lot of different investment options out there, and a lot of investors are tired of investing in your traditional investments, stocks, bonds, mutual funds, real estate investment trusts, and things like that, and they're looking for other investment options. There are direct investments investors have access to, and so we want to make sure investors are informed and educated on some of the options that are out there, some things to watch out for, and just really getting a good general fundamental understanding and overview on private money investment choices. So what is private money? It's simply a source of capital for an investment that does not come from a bank. There are a variety of sources of private money investors can resource, and depending upon the source of capital will really dictate the types of investments you would want to use that capital for. So I'll give you some examples. Obviously, you have cash, so investors that are sitting on cash, it's not really earning any money. You can take advantage of opportunities. And the cash could be sitting in individual accounts, trust, LLCs, family limited partnerships, etc. But having liquid cash on hand does give you the option to take advantage of investment opportunities that present themselves. The difference between private money investment choices versus traditional investments is generally they are going to come available, and there's going to be a period of time in which they need to be funded. And so having liquid cash available is important so you can take action. We also have trust, family limited partnerships, limited liability companies. Also, about 25% of the investment capital we work with comes from qualified funds, retirement plans. There's many different types of retirement plans. All types of retirement plans can be self-directed, meaning that investors have choices outside of the traditional investment vehicles that they can actually do inside of their IRAs. Also, credit worthiness. I'll give you an example. We are going to close on a $20 million apartment complex, and we need to have bank financing in place. We have an investor that's got a pretty substantial financial statement, and we need a guarantor for the loan. So we've worked with investors before that will act as a guarantor based on their credit worthiness, and in exchange they typically would get a fee for guaranteeing the loan, as well as they may receive an equity position in the project without actually having to write a check. Typically this is done on projects where the financing is non-recourse. However, there are projects that are recourse loans. We've had investors be willing to be part of the guarantee. Debt equity. Debt equity is basically equity that's in a personal residence or an investment property. So for example, if you have a rental property and it's paid for all cash, and you have a renter in there, the renter is producing cash flow for the owner. Debt equity would be where you have a personal residence, for example, you've paid off your home. However, your home was still a liability to you. It takes money out of your pocket. An investment actually puts money in your pocket. So one strategy investors can use is to turn their debt equity into an income producing asset. And so you would do that in the form of a home equity line of credit is the easiest strategy to use. It allows you to basically have a checkbook attached to your personal residence that you can create a mortgage by writing a check. Once the amount that's been resourced is paid off, then you have the ability to do that again versus refinancing your house or getting a home improvement loan does not give you that kind of flexibility. This type of private money I would recommend only doing on your own project. So if you are somebody who fixes and flips homes, instead of working with a hard money lender or a private investor, you may use debt equity in your home where you're in charge of managing the whole process and selling out of the investment and then paying off the loan you used from the debt equity. Cash value life insurance policies. We actually have a wealth building strategy workshop that strictly talks about some of the various different things you can do with cash value life insurance, but one of the unique features is similar to debt equity in a home. You have debt equity in a cash value life insurance policy, and this is mainly on whole life type insurance where you have a cash value. You can actually borrow out up to 90% of the cash value in a permanent life insurance policy while not reducing the earnings capability to be able to use those funds to do other things. Similar to debt equity in your home, I would only suggest using this type of money on investments that you're personally managing yourself, so you have a little bit more control. And then credit lines. Credit lines can also be used. When I first started investing in real estate, I wasn't working with investors, and we were flipping homes primarily, and I used a credit line strategy, starting with $30,000 of credit lines. I built those credit lines up to $300,000, and that was actually my source of capital that I used to be able to close on a transaction, basically all cash, using the credit line. I made payments on the credit lines with the credit line money until the home sold, then I paid off the credit line, and whatever the difference was the profit that I generated. So what is private money looking for? What are investors looking for in investing outside of the traditional investment vehicles? Just better investment options, other choices besides being tied to the stock market. Better returns and certainty of a return. More predictability and stability with the returns that they get, and more control. As well as peace of mind. You can put your money into an annuity and you might get a guaranteed 3 or 4%, but if you think about the amount of capital you have to consume to actually provide a reasonable income without downsizing your lifestyle, you make $30,000 or $40,000 a year off of $1 million. That doesn't give you a lot of peace of mind when you spend all that time to accumulate that kind of capital. So when you're investing in direct participation programs or direct transactions, there's generally the active investor, who would be considered the sponsor or the general partner, and there's the passive investor that would be considered the limited partner. So the investment sponsor should be able to provide to the limited partner or passive investor the ability to do adequate due diligence, create a win-win situation for the investor as well as the sponsor for doing all the work, be a good steward of the investor's capital, and manage the investment on behalf of the investors wisely. Identify and manage investment problems. One thing that I can guarantee you is that every investment transaction we've ever done has had its own set of challenges, and you've got to be able to identify what those challenges are, ideally in advance, and when the challenges come up that you weren't expecting, you've got to be able to manage those and come up with solutions. and then execute on those solutions. The main objective is first and foremost to protect investors' capital, and then secondarily generate a return for the investors, and then the sponsors also should benefit for doing all the work, but it's in that order. And then show performance. Typically, depending upon the size of the investment transaction, there's going to be entities that are used. So I wanted to cover a little bit about the use of entities and how those play into certain investment transactions, liability that's involved to the investors and or the sponsors, general partners on the projects, so you can understand how to make the right choice and make sure the right type of entity structure is being used so everyone's protected. So the first is partnerships. So you have direct partnerships. A partnership is basically an agreement between two or more entities or people. And there's personal liability, net worth, stocks, cars, homes, bank accounts, etc. in a direct partnership. Then there's limited partnerships. So whether it's a limited partnership or a limited liability company, limited means that there's limited liability to the investors. So limited partners are only liable for what they have contributed. I have a lot of investors ask, well, what's the worst thing that can happen? What's the risk? With a limited partnership or a limited liability structure, the liability to the investor is limited to the capital that they invest. For example, if you go and purchase a single-family home, it's $100,000. You put a $70,000 loan, and you put up $30,000 of capital. In this case, the investor that purchased this home is not only liable for the $30,000 that they put up, but if it doesn't work out and for whatever reason the renters weren't in there and the home got foreclosed, you would also be liable for the loan. In a limited partnership structure, the LP investors are their liability is limited only to their invested capital. So general partners are typically personally liable, needs to be registered, and it's advantageous when two entities work together. And then as far as tax benefits, there's flow-through taxations. So there's no tax at the federal level. Limited partnerships will have to file an annual Texas franchise report, and any tax benefits that do occur flow through to the members. So this is just kind of a visual. You have your investment transactions shown as number 1 and number 2. You have partner number 1, 2, and 3. These partners are directly liable for whatever happens at the transaction level. With an LLC or an LP, there's certain advantages and benefits. It's the most popular entity to hold real estate in is a LLC or an LP, and kind of provides the best of both worlds. You have the flow-through tax benefits, but you also have the limited shield of a corporation, and can shield you from liabilities at the investment level, the transaction level. So limited liability companies, members and managers have an interest in the company. It's got the benefits of a corporation and a partnership with few disadvantages of either entity. There's no personal liability if it's set up correctly, no federal tax if it's set up to be taxed as a partnership, and it's easy to set up, easy to modify, and easy to wind down, and requires annual franchise tax report. And you can also title real estate under your entity name. We'll talk about this a little bit later in the workshop on how that's actually done. And then the transactions with the entity shield you personally. So another picture here. You've got the members that contribute to the LLC. The LLC takes ownership of the investment transactions. This limits the liability from the transaction to the LLC and protects the members. However, the personal assets are protected, but they do get the tax benefits that flow through to them depending upon the type of investment. So there's two types of structures we use. It's either a single asset LLC. So let's say, for example, you're going to do a $20 million apartment complex. An LLC is going to be created. The LLC will be the owner of the apartment complex, and the investors then would contribute to the single asset LLC to get their pro rata share while still providing the liability protection. So it's generally used for larger investments. LLC owns the asset outright. Investors invest in the LLC, normally through a private placement memorandum, a PPM, depending upon how many investors you're going to have. 100% of the investment is tied to a single asset, and investors may choose to invest smaller amounts to mitigate risk versus a fund model, which we'll talk about here in a moment. For an IRA, this would be considered an LLC investment regardless of what the asset is. So for those of you that like to use a self-directed IRA, and let's say you're doing a real estate project that's owned by a single asset LLC, since it's not a direct investment into the property itself and you're investing in an LLC, the paperwork you would fill out would be for an LLC investment. The other model is a fund structure. So we've done a lot of single asset LLCs. We've also done quite a few fund models. So the fund model is generally used to invest in multiple assets. Similar to a mutual fund that owns a bunch of stocks versus buying individual stocks, the fund model will allow you to spread capital out over more than one investment. The LLC owns all of the assets outright, or could be a fractional owner in the investment. Investors invest in the LLC. In this case, is generally going to be through a private placement offering. Investment capital is diversified across all assets in the fund. So if you were going to purchase 5 separate investments inside of a $10 million fund and invest $2 million in each investment, if one of those investments didn't perform as well as you wanted it to, the investors are able to mitigate some of that risk because the investment capital is not tied to a single investment. So investors in a fund model may choose to invest a larger amount due to the capital being diversified and spread out across more than one investment. And then for an IRA, this would also be considered an LLC investment regardless of what it is the fund winds up investing in. So there's organizational structures that are used based on the project. So limited partnership, you're going to set up a limited partnership organized through an LLC, funded through a private placement memorandum, a PPM. And then there's certain rules and regulations, SEC, Securities and Exchange Rules and Regulations, investors need to be aware of as well. So there's accredited and non-accredited investors, and depending upon how the investment is organized is going to dictate who is allowed to invest. An accredited investor is considered sophisticated, means they have at least a $1 million net worth excluding their homestead. They make $200,000 income individually for 2 years, or $300,000 income married filing jointly for 2 years. So if you have an individual and the husband makes $150,000 a year and the wife makes $150,000 a year, individually by income they're not accredited, but jointly because their income is $300,000 a year, they would be considered accredited by income. So you could be accredited by income and or net worth. Different accreditation rules for entities. So there's actually a lot of different types of structures and have different methods in which to determine if they're accredited. So just as an example, if you're investing in an LLC and the LLC holds $5 million in assets, however, the members of that LLC are all by definition non-accredited, the entity is still considered accredited because of the amount of assets it holds. If the entity holds less than $5 million in assets, then in order for the entity to be considered accredited, all of the members would also individually have to be accredited by income or net worth or both. Non-accredited investor is an individual that makes less than $200,000 of income and less than $1 million net worth, excluding their homestead. So you would have to fall under both of those definitions. So if you had $1 million of net worth and your income was $100,000 a year, you would still be considered accredited by net worth, not by income. A non-accredited investor makes less than $200,000 a year and less than $1 million in net worth. So private placements filed under a Reg D exemption are limited to 35 non-accredited investors. So if you're raising $10 million of capital and you had a $100,000 minimum investment, the maximum you could allow for non-accredited investors to participate with a minimum investment of $100,000 is 35. You typically would not have a non-accredited investor investing more than 10% of their net worth, so the maximum you would have would be $3.5 million out of the $10 million raised. There's different kinds of transactions. So there's investment transactions versus securities transactions. So I wanted to make sure you understand the difference. There's some risks involved to be aware of when you're looking at doing an investment. So an investment transaction is single investor, single loan, single investor, single investment. So let's say you know somebody that fix and flips homes, and they're looking for a hard money loan. And let's say you have a $700,000 net worth and you're non-accredited and they need $500,000 to do the fix and flip. Buy it and fix it up and be ready to sell it. And you could either get an interest rate on your money if it's a loan, or you could do a sharing arrangement of profits if it's an investment, or you could do a combination, an interest rate plus a sharing of profit. However, if you only have a $700,000 net worth, that is a significant portion of your total net worth tied to a single transaction. Any type of advertising is permissible. So if you wanted to put a sign up on a billboard advertising investments for investors, as long as it's a single investor, there's nothing wrong with doing that. Marketing materials don't need to be approved by a legal counsel or any kind of compliance. And the investor can invest as much of their personal net worth an investor wants to. So, a lot of investors, they accumulate some cash, they want to go buy a rental property, and let's say all the money they have to use to invest is $250,000. They need $200,000 to close on this single family home they want to turn into a rental. And even though $250,000 is all of the capital you have the right to invest as much of your money as you want to into a single investment. And that would only leave you $50,000 of cash after buying only one single family home. So there are some risks that you need to take into consideration when you're looking at direct investments like this. A securities transaction is when you're pooling capital from multiple investors regardless of what the investment is. There may be filing and registration requirements, must use an SEC attorney, and you cannot generally solicit for investment capital unless it's structured as a Reg D 506C, which allows for general solicitation and is also limited to accredited investors if you're going to market that way. So, for example, and I've seen this a number of times, going back to the guy that does fix and flips, and if he's going to fix and flip a home and he needs $500,000 of capital and he can't get enough money from a single investor to do that, he starts having 5 separate promissory notes for $100,000 each. Now he's actually pooling money together and may think that that's okay and that it's an investment transaction or a real estate transaction, whereas in fact he's now pooling money together, and if he had problems and an investor complained, he could wind up dealing with a securities violation because of the fact that he pooled money together. Also, with securities transactions, there are limitations on how much of a person's net worth an investor can invest. Generally, my recommendation is investors don't invest more than 10% of their investable assets into a single investment, whether it's a single asset LLC or a fund model we talked about. It's also important that you know your investors. So if you have investors investing, there's suitability requirements if you're dealing with securities transactions. There's not if it's a direct investment transaction. Generally, there's what's called a purchaser suitability questionnaire. Investors are required to fill out, and this just makes sure that they're suitable to do the investment that they're wanting to do, including the amount of the investment that they're considering doing based on their net worth and income and a few other factors. Both income and net worth are taken into consideration. Current investments and investment experience is looked at. You also have to understand the investor's investment goals and objectives. So, for example, if we have an investor that has an income strategy and they're looking for cash flow producing investments, and we had a land acquisition opportunity and there would be no cash flow for 5 years, but yet it might generate 100% return over that 5 years, the return is great, and I'm sure the investor would benefit from that, but that investment actually does not meet that investor's goals, which would be to produce cash flow. So those kinds of things have to be taken into consideration, and if the investor wants to invest, but the investment doesn't meet their goals and objectives, sometimes you have to decline accepting the investment from the investor because it doesn't fit their parameters. And they have to invest suitable investment amounts. Kind of going back to what I discussed earlier, somebody can't just go and put 50% of their net worth into a single investment. If you're doing a securities transaction, it's not suitable. And then we have to maintain all suitability information in the event of an audit. So just to discuss different partnership structures. So based on the size of the investment and the kind of investment you're trying to do is going to dictate which structure makes the most sense. So if you're doing a single family home or direct investment, you're basically going to have a couple of scenarios here. You're going to have somebody that's going to manage the investment, just using a fix and flip as an example. So the person that's actually the active investor that's going to identify the property, work with the subcontractors and manage and oversee the project and make sure it gets completed, gets listed, and gets sold, that's the managing partner. And so the managing partner may be working with a debt partner that would do a loan or an equity partner that would put up capital. A debt partner is generally going to receive an interest rate and possibly origination points or exit points, whereas an equity partner, they want a percentage of profits. You can also do a hybrid structure where you might pay an investor a lower interest rate, say 8% for the use of the funds and 20% of profits, versus maybe a 50-50 split on profits if an equity partner put up all the cash. Again, it kind of goes back to what the investor wants, and that's typically structured and organized through just a simple promissory note structure. So you've got a lot of flexibility to kind of negotiate with your investor and try to meet their needs and goals, and maybe want to have a kind of a fixed return structure and be okay with not getting as big of a profit in exchange for protecting their downside. So let's say the project wasn't as profitable as you wanted, and the investor would wind up getting a 5% return. If you had a hybrid structure where the investor has to get 8%, then before you would go into a split, that investor would have to get paid their interest rate first, then whatever's left is split. Now the investor's downside is protected, and the managing partner may not wind up getting much for his work if the project went long or they went over budget or something of that sort. The second option is for multiple single family, or you're going to do a small commercial transaction. Maybe it's a 30 or 40 unit apartment complex, or something that doesn't require a ton of capital. Let's just use an example of you need $500,000. You might not go through the whole cost, expense, and time to set up a full-blown private placement offering and just organize an LLC. You have up to 10 investors, and in this case, if you have 10 investors, you have an LLC. The investors are basically purchasing membership interest in that LLC for their capital contribution. So in this case, with $500,000, the minimum investment would be $50,000 if you can have up to 10 investors. Assuming all 10 investors do $50,000 each, they all just get their pro rata share of the entity, and then you have the managing partner, and they would be the one that would oversee everything, and then they would get a percentage of the rewards from their efforts for managing the project. So there's generally for smaller transactions, or if you wanted to beta test something that you wanted to do on a larger scale, you might start out with just a smaller structure to scale up. The third option, and this is primarily what we work with in most cases, is a private placement offering, and this is for larger investments. It doesn't have to be real estate, but this is where you're going to have more than 10 investors that are going to contribute and invest in the LLC through a limited partnership organized through a private placement, as we were discussing earlier. You may have more than one manager in this case. The managers are responsible for overseeing the investment, and this structure is a lot more stringent from a compliance standpoint, and there's a few ways to organize and capitalize a private placement we'll talk about here in a moment. But this is for larger transactions, like the $20 million apartment complex might need $5 million of capital. In most cases, you're going to have more than 10 investors, but in some cases you may not. It depends on the investor base you're working with. So private placement memorandum, PPM, it's called a private placement because it's private, so it's not available to the public. You're not going to go on a stock exchange and find private placements available. It's regulated by FINRA if you're processing it through a broker-dealer, the state in which you do business in. So if you have registered your private placement in Texas, Florida, and California, then you are also governed by the state of Texas, California, and Florida, as well as the SEC. These are normally organized through an LLC, so there's limited liability. You do have, based on the investment, if there's tax benefits, they flow through the investors, and you receive a Schedule K-1 at the end of the year. And there's three ways you can actually place a PPM, meaning how you would capitalize and fund the private placement offering. The first one is through what's called direct issuer transactions. This is basically, a lot of people that will raise capital, friends and family, are going to do that as a direct issuer. You can't pay commissions. You can pay salaries and bonuses. Only officers of the company can sell. So if you have yourself and maybe two other people, you're going to work together to raise the capital. Those are the only people that can actually raise capital. You can't have somebody that's not written into the legal documents out there soliciting for investors. Or if somebody's trying to refer investor to you, you can't go and offer them a commission through a direct issuer transaction. And there's limitations on how many offerings per year you can do under your individual name. Then there's broker-dealer transactions. And so with a broker-dealer, there is way more compliance involved. You're regulated by all three regulatory agencies, FINRA, the state, and the SEC, whereas a direct issuer transaction is regulated by the state and the SEC only. Broker-dealers get audited no less than once every 2 years, so you're guaranteed to be audited on a regular basis. The the records and the information on your investors have to be kept. So because you get questioned on why an investor is being allowed to invest certain amounts and things of that nature. And only a licensed registered rep with the broker-dealer can actually do the selling. Reps can receive a commission, and this is the only structure in which commission can be paid for raising capital, and there's no limit on the number of offerings per year. Our company, we do both direct issuer transactions on the DMI Holdings side, but we also have a broker-dealer, DMI Securities, that's a branch office of Nobles and Richards, and the people that are with DMI Securities hold securities license, and they're overseen by the managing broker-dealer. And then the last way is through a registered investment advisory firm, an RIA, and the IA, the investment advisor, does the selling. They cannot receive a commission. They get compensated actually by a percentage of money under management. So this is more typically used for wealth management than it is for raising capital. However, a lot of boutique RIA firms that want to provide other investment options besides traditional investments to their clients may work with some private placements to, in most cases, they have discretionary authority over their client's portfolio. For those that want to invest in alternative assets, they can allocate a small percentage of their client's portfolio into, a private placement for real estate or some other type of investment. Additional compensation of a percentage of profits can also be paid to the RIA, but I can tell you from the ones we've worked with, they mainly are looking to just give some diversification to their clients, not so much looking for extra fees and percentage of the deal and that type of thing. And you also have no limit on the number of offerings per year you can do. So private placements are uncorrelated to the stock market, allow you to diversify your portfolio. If done well and put together correctly, can provide above market returns, above average returns. You're investing directly into private companies versus buying stock, and you can participate in unique investment opportunities that you otherwise may not have an opportunity to invest in. Some of the best investments are available through private placements. They are considered by definition high risk, no different than a mutual fund. A lot of people read the private placement memorandum and they go, oh man, this is really risky, but they don't read their mutual fund prospectus because it basically has all the same language in there. So all investments that don't have guarantees attached to them, like a CD or fixed rate annuities, there's risks that you need to understand and consider before doing an investment. Investors must be considered sophisticated to qualify to invest. This is whether you're accredited or non-accredited. So if you are accredited, you're considered sophisticated, whether you are or are not. I've met a lot of accredited investors that I would say are not sophisticated. And I've met a lot of non-accredited investors that are, but a non-accredited investor would need to be sophisticated. So, for example, going through workshops like this, if you're a non-accredited investor, gaining knowledge and an understanding on investments outside stocks, bonds, and mutual funds would help you to be considered sophisticated because you've had some training, some education. And private placements are generally illiquid. So if you have a need for the cash right away, it's not like a stock or a mutual fund that you can, call up a broker or get online and convert it to cash right away. So you're really only going to use the part of your investment portfolio that you don't mind being illiquid for a period of time. And then step above that would be a real estate investment trust. There's publicly traded and non-traded REITs. REIT is a real estate investment trust. And these, whether they're public or private, are organized where investors, let's say you're doing real estate projects, commercial real estate projects inside the REIT, and you have passive income and a lot of flow-through tax advantages that you would actually benefit from if you invested directly through a private placement, for example, that would flow through to the members. Through a REIT, you have tax advantage money going in and then gets distributed out as a dividend, which is a completely separate tax structure. So real estate investment trust is publicly available, regulated also by FINRA, the state, and the SEC. Does definitely provide you the limited liability. You just don't get the flow-through tax benefits that you would through direct real estate investment. And they're also sold by a licensed securities broker or financial planner. It'd be a registered rep or an investment advisor. And then there's various different legal structures based on the structures that we just covered. So just to put them all up here, you might structure the investment as a loan. You might simply need nothing more than a promissory note. This would be for kind of the phase one option I showed you. You might be purchasing membership interest, could be a joint venture, general partnership, a private placement, or direct participation program. So dependent upon the investment and how it's organized is really going to dictate the type of legal structure that's used to allow investors an option and an opportunity to invest. Then based on what you're doing, there's various different legal counsel services that are generally used. General counsel is used for, drafting of documents and some more general legal work. A business attorney or a transactions attorney is going to do your securities work. They would put together your private placement offering and that type of thing. And then you have litigation attorneys that are basically going to help if you have any legal issues and lawsuits ensue or you need to pursue somebody. You also want to consult with tax attorneys based on the kinds of investments. You really want to get a full understanding of how the tax benefits work. So we've had different kinds of investment structures. For example, we did a mobile home park. Not a typical one that's a rental model, but it's really a note pool secured against real property, where we're originating seller finance notes, and so there's some interesting dynamics there with how the taxes work. So we had to consult with a tax attorney to really get full clarity, to also be able to provide their opinion on how to book the taxes for our CPA that actually files the tax return. So depending upon the investment, you may need to consult a tax attorney, and the real estate attorney is used for doing the real estate transactions. So you'd be surprised. I've worked with and talked to literally thousands of investors, and it amazes me on some of the things that I've seen and hear. Hope for the best and prepare for the worst. Don't do business on a handshake. I could tell you some horror stories of some things I've seen, but you don't go do an investment without the proper legal structure in place before you start writing checks. I've seen people that have wired money to people, even in other states that they've never met, because it was this investment that's going to get them 100% of their money back in 3 months, and you can understand what happened from there. And they, wound up losing their money. So you got to make sure you have proper legal structure in place. A few things to watch out for as an investor is just lack of a proper legal structure. You have to have your legal documentation in place, and if you don't understand it, you should have your own legal counsel review it before you make an investment. Lack of transparency. You should be able to, see what's going on financially with the investment. That could come from being provided the P&Ls. When we used to fix and flip homes, we would do each home in a separate bank account, and we would just give the investor view access of the bank account. Just a real simple way for that investor to be able to see, along with the budget, could see the transactions and going on, to give them confidence so that they're aware of how things are going. But you got to be able to report and provide the transparency to your investors. Also, you have to watch out for unusually high returns. It's not that you don't have investments that can produce unusually high returns. Generally, there's more risks associated with that. But if a person is talking about an investment that can pay you back your money in 3 months, 4 months, 6 months, that's pretty unheard of. Not that it doesn't happen, but you better really totally understand what it is you're putting your money into. I'll just give you an example. We've had opportunities presented to us for cannabis deals and some of the other things in that industry, and the returns on the pro formas are really high. We have not moved forward. There's also a lot of restrictions and regulation issues. We haven't moved forward on those, although the returns look great. There's also a lot of things that are problematic with that. So again, just understand what it is that you're investing in. If you don't understand it and you don't have somebody that you trust to be able to evaluate it and help you make a decision, then it's best to just pass. Investments that are too complicated, I don't invest in anything I don't understand. If I don't understand how I can generate a return, I simultaneously don't understand how I can lose money. And so no matter how good the return is, I've passed on some really amazing returns, which then, down the road and years later, following up with the people that presented it to me, I ask them how the investment is going, and I don't recall any one of them that actually succeeded. And so for me, if I don't understand how I can make money and I don't understand how I can lose money, I'm just going to go ahead and pass. I'd rather get a conservative return than try to get a big return and wind up having a capital loss. And then obviously, if somebody doesn't have a track record or is not able to provide references, that doesn't mean you shouldn't work with them. If you've got a family member that is trying to get into real estate, they don't have a track record, but they need to have education and training and have invested time into learning, and hopefully they have a mentor that will oversee what they're doing, and you might be willing to financially support that person. So it doesn't mean you shouldn't do it. You'll generally wind up with a better deal and a bigger sharing arrangement by taking a calculated risk, but you definitely want to have somebody that's got the knowledge, at least in training, to execute, even though they may not have the experience. And the other thing I always tell people is beware of deal brokers, white elephant hunters, and anybody else is calculator rich. I have opportunities brought to me all the time just based on the industry that I'm in. And, they have all these great ideas, and my response to most of these people that are basically just trying to broker a transaction for a fee versus actually being the operator, my question is, looks like a good opportunity. How much is your mother investing? And in most cases, obviously their mother is not investing, and that's kind of my litmus test. If it's such a good opportunity, who do you personally know that's putting their money in? So we generally just stay away from stuff like that. So it's a great partnership. Passive investors need active investors, and active investors need passive investors, and working well together. The passive investor needs to, do their homework on the active investor, and the active investor needs to be working with passive investors, quite frankly, they want to work with. Just because somebody has money, I know a lot of people that have a substantial net worth and a lot of capital that we don't work with because, we don't like the way that they, treated us or whatever, just not a right fit. So, you do business with people you want to do business with, and you're both comfortable with one another, and you work together. With that, we're going to conclude, and if you want more information, you want to learn a little bit more about DMI Holdings, our website is down in the bottom left-hand corner of the slide, www.dmi.holdings.com. In the upper right-hand corner of our website, there's a slide deck, just give you a good general overview. And if you have questions or are interested in learning about investment opportunities, and like to talk to someone, just email us at invest@dmi-mgt.com. Again, for any investment related questions or interested in learning more about investment opportunities, just email us at invest@dmi-mgt.com. Again, this is Eric Mattingly, and we appreciate you joining us today.